Welcome back to the Deep Dive, where we plunge into complex topics to bring you those unexpected insights. Have you ever paused to think about what goes on behind the scenes when a massive company's finances are scrutinized? Or perhaps wondered if there's one single document that holds the power to make or break an auditor's entire opinion on whether those financial statements are truly trustworthy? It might sound like something found in a dusty filing cabinet, pretty far removed from daily life, but today we're dissecting a document that's absolutely foundational. Foundational to financial transparency and, crucially, to public trust. It's the Management Representation Letter. Our mission today: to unearth precisely why this letter is so much more than just a bureaucratic formality. It's a critical, legally binding component of the audit process. It reveals the serious stakes for both companies and the auditors themselves. And we're drawing our insights from, well, essential professional texts and decades of audit practice.
It really is a deep dive into what I'd call the bedrock of audit assurance. So yeah, let's truly explore this.
Okay, let's dig into this then. A Management Representation Letter. Just hearing the name, it sounds pretty official, perhaps a little dry, maybe.
It does have that formal ring to it, yeah.
But what is it, at its very core, for those of us who aren't deep in the weeds of accounting and auditing every day? What does this document actually represent, and why is it even needed?
Sure. So at its essence, the Management Representation Letter is a formal written statement. It comes from the client's management, that's the company being audited.
Right, the company itself.
And it's addressed directly to the independent auditor. Think of it like management's solemn pledge, almost. A really critical written confirmation of various assertions they've made throughout the whole audit.
Okay, so they're putting it in writing.
Exactly. Now, what's kind of fascinating about this process is while the auditor actually prepares the specific text of this letter, carefully drafting all the points management needs to confirm.
Okay. The auditor writes it.
They draft it, yes. But then it's printed on the client's own letterhead. And here's the really critical part. It's signed by the client's top management. This isn't just a courtesy. It ensures the letter carries the full weight of the company's authority and responsibility.
Got it. Signed by the big bosses.
Precisely. And the timing is also incredibly precise and significant. It's obtained right at the conclusion of fieldwork.
So after they've done most of the checking.
That's right. After the bulk of the auditor's work, the rigorous evidence gathering is done. And crucially, this letter isn't just a snapshot of one moment. It covers the entire period under audit, right up to the very date of the auditor's report.
The whole year, potentially.
Oh, well, whatever the period is, yes. Right up to the day the opinion is issued. So management is signing off on everything that happened and everything they asserted, from the start of the financial period all the way to that final date.
Well,
you can absolutely think of it like a formal affidavit.
Yeah.
Or, a sworn statement in court. It summarizes all those key assertions, assurances, disclosures management has made, verbally, implicitly, throughout the whole audit. It's their ultimate, formal, and legally binding commitment to the auditor.
So it's definitively not just a polite thank you note or some casual summary. It sounds like a very serious, very deliberate, and clearly legally loaded document.
It absolutely is.
That immediately raises the question, why is it so incredibly crucial? What are the primary foundational reasons an auditor must obtain this letter before they can even think about finalizing their work and issuing their report?
Indeed, it's far more than just a courtesy or a simple admin step. There are really three primary purposes that make this letter utterly vital, absolutely essential for the integrity and reliability of any audit.
Okay, what are they?
First, and maybe the most straightforward, it serves to confirm representations explicitly or implicitly given to the auditor. Throughout an audit, auditors ask countless questions, management gives explanations, tons of information gets exchanged, often just verbally.
Right, lots of conversations.
Exactly. This letter, it's like the formal capstone. It reinforces all those verbal assurances, all that information management provided. It leaves absolutely no room for ambiguity, no he said, she said stuff. It puts everything down, definitively signed.
Cements the understanding.
Precisely.
Yeah.
Imagine an auditor asking about some complex transaction, getting a verbal explanation, and then seeing that same understanding formalized in writing, signed by the CEO. It locks it in.
Okay, that makes sense. What's the second reason?
The second purpose is to indicate and document the continuing appropriateness of such representations. An audit isn't static, right? It covers a period, often a full year. Information they gave early on, maybe months ago, might have been accurate then.
But things change.
Things absolutely change. So what about now, right up to the very day the audit report is issued? This letter confirms that the info given earlier is still true, still relevant, still valid. It essentially locks in management's assertions about the financials and the facts, affirming them as accurate and complete as of the report date. That's vital because business moves fast. The auditor needs that assurance right up to the last possible second.
Okay, so it confirms past statements are still good now. And the third.
And finally, the third purpose is to reduce the possibility of misunderstanding concerning matters that are the subject of the representations. Clear, written statements, especially on complex or, nuanced financial stuff, they minimize ambiguity. They cut down the chance of misinterpretation or future disputes.
Like everyone's on the same page officially.
Exactly. Imagine a company with a really complex revenue recognition policy. Without a formal, signed statement from management about how they understand and apply it, years later, there could be a huge fight about what was actually agreed or understood.
I can see that happening.
The letter creates a definitive, unambiguous record of what management asserted. That's critical, not just for the auditor, but for anyone relying on those financials. And this letter, it's considered a vital piece of evidential matter. Often, it's the final and most crucial piece an auditor needs and must obtain before they can confidently issue their report. It really is the capstone of their evidence gathering.
That makes perfect sense. It's all about layering certainty onto those verbal chats, cementing them into a concrete, undeniable record. But here's the really crucial question. Is this something auditors try to get, or something they absolutely have to get? What happens? What are the real-world, tangible consequences if management just refuses? If they say, nope, not signing that?
Yeah, this is where its critical importance really hits home.
Yeah.
It moves from, good practice to absolute necessity. It is not optional. It is, without question, mandatory. The auditor must receive this letter to be able to render what's known as an unmodified opinion.
The clean opinion. The good one.
That's the one. The clean opinion. The gold standard. It says the financial statements are presented fairly in all material respects, according to the rules, like U.S. GAAP. That's what companies and investors need to see. It signals health, transparency, reliability.
Okay, so it's required for the clean bill of health. What if management digs their heels in?
Right. If management, for whatever reason, refuses to furnish this written representation letter, the consequences are incredibly severe and immediate for the company. The auditor generally has two main options, and neither is good news for the company's future. They'll either issue a disclaimer of opinion, or they will withdraw from the engagement entirely.
Withdraw. Just walk away.
Potentially, yes. But let's first unpack a disclaimer of opinion. That means the auditor is saying they cannot form or express any opinion whatsoever on the financial statements. They're essentially telling the wing, look, we don't have enough information or enough assurance to tell you if these numbers are reliable.
Wow. That sounds bad.
It's devastating. For a company that's like a huge flashing red light for investors, lenders, regulators, everyone, it signals massive unresolved issues, a fundamental lack of audit evidence, or just a complete breakdown of the relationship.
So trying to get a loan or keep investors happy would be tough.
Extremely tough. Imagine a public company needing capital or trying to maintain its stock listing, a disclaimer. That could lead to immediate questions, stock price plummeting, trouble getting loans, maybe even getting delisted. It shatters market confidence.
Okay, so disclaimer is one route. What about withdrawing?
Withdrawing from the engagement is an equally grave signal. It means the auditor feels they just cannot complete their work because of fundamental problems, often boiling down to a lack of trust or cooperation from management.
So either way, it's a huge red flag.
A massive one. Both outcomes fundamentally undermine the credibility of the financial statements and the company itself. It's like, needing a critical signature on a legal document to make the whole process valid.
Right.
Without the MRL signature, the audit is essentially invalid. The auditor just cannot fulfill their responsibility to the public. Their ability to stand behind their opinion hinges on getting that letter.
Wow. Okay.
Okay.
So it's mandatory, and the consequences of not providing it are absolutely dire for the company's reputation, its funding, its public standing. Given that weight, let's talk specifics. When exactly is this letter dated? And who exactly, by name or position, has to put their signature on the line?
Right. The specifics here are the timing and the signatories are incredibly important, and for very good reasons. Regarding the when, the client representation letter should always be dated as of the date of the auditor's report.
The same day the audit report comes out.
Exactly the same day. This creates that direct, crucial link. It connects management's final assertions to the exact day the auditor issues their independent opinion. It ensures management is confirming everything right up to the moment that report becomes available. It minimizes the risk, of some big event happening after the field work, but before the report date, that doesn't get reflected.
Okay, but what if, practically, they can't sign it on that exact day? Logistics, maybe?
That happens. Real-world circumstances sometimes prevent management from physically signing and returning it on the spot. In those cases, the auditor might, as an interim step, accept oral confirmation from management. This would be given on or before the audit report date, confirming they've reviewed the final letter and they will sign it. No exceptions.
So, a verbal promise
A
first.
verbal promise, yes. But, and this is a totally non-negotiable condition for the auditor, actual physical possession of the signed representation letter is absolutely necessary before the auditor's report can be released.
No signature in hand, no report out the door.
That's the rule. The auditor simply cannot issue their opinion until that signed document is received. It confirms management's responsibility in black and white.
Okay, that covers the when. Now, the who. Who takes the pen?
The who is critical. The primary signees are almost always the Chief Executive Officer, CEO, and the Chief Financial Officer, CFO.
The top two. Makes sense.
It does. The rationale is pretty straightforward. These are the highest-ranking managers. They have overall responsibility for the company's financial and operating matters. They should have the most comprehensive knowledge about everything in that letter. And ultimately, they bear the final responsibility for the accuracy and integrity of the financials.
So the buck stops with them, officially.
Officially, yes. Think about it years down the line. If there's a lawsuit over misstated financials, this letter, signed by the CEO and CFO, it's going to be Exhibit A. It directly links them to the asserted accuracy. It turns potential liability into something very concrete, very personal.
So it's not just the company signing, it's them personally.
Their names are on it. Their reputations, their careers, maybe even their legal liability are quite literally on the line. Now, while the CEO and CFO are key, sometimes other officers or employees might be asked to sign sections or even additional letters.
If it's about their specific area.
Exactly. If specific representations fall more directly under their control and they have unique knowledge or responsibility, but the weight of the CEO's and CFO's signatures together, it's immense. It signifies personal accountability and that serious, legally binding commitment to the information given to the auditor.
It's clear that both the who and when are very specific, really emphasizing responsibility and timing. And you've mentioned material matters and adequate disclosure a few times. Can you elaborate a bit more on what management is asserting about these matters, and what does materiality truly mean in this specific audit context? It feels like a word that gets used a lot in business, but what's its real meaning here?
That's a great question. Materiality is probably the cornerstone concept in auditing and financial reporting. So in the MRL, management makes this overarching fundamental assertion that all material matters have been adequately disclosed to the auditor.
Meaning nothing important got left out or hidden.
Exactly. They're formally confirming that nothing significant, nothing that could impact the financial statements or a reader's understanding has been hidden, omitted, or misstated. It's a promise of complete transparency on the big stuff.
Okay, so what counts as big stuff? How is material defined?
Right. Defining materiality itself is key because it involves judgment. The representations in the letter may be limited to items that management and the auditor mutually agree are material. So what does that actually mean? Basically, items are considered material if an omission or a misstatement of that information, whether it's a number, a disclosure, an event, could change or influence the judgment of a reasonable person relying on those financial statements.
So would it make a difference to someone making a decision based on the numbers?
Precisely. Think about it from the user's view. If you're an investor deciding whether to buy stock or a bank deciding on a loan, would knowing about this particular missing piece or error change your decision? Or change how much money you'd risk? If the answer is yes, then it's almost certainly material. It's all about the potential impact on economic decisions.
Can you give an example?
Sure. Let's say a company accidentally recorded a $10 expense as $100,000. That would almost certainly be material, right? It drastically changes the reported profit, might even swing them from profit to loss. That would definitely influence an investor's judgment.
Yeah, clearly.
But if that same $10 expense was accidentally recorded as, say, $11, highly unlikely to be material, it wouldn't change anyone's overall view of the company's financial health.
Okay, I get the concept for dollar amounts, but you mentioned an important distinction.
Yes, and this is really crucial. Materiality considerations, that threshold, do not apply to items not directly related to financial statement amounts.
What does that mean?
It means management must make available to the auditor all minutes of meetings, Stockholders, directors, committees, and all financial records, regardless of whether any specific item within those minutes or records seems financially material on its own.
Why is that, if it's not a big dollar amount?
Because, while, say, a discussion in a board meeting about a potential lawsuit might not have a dollar figure attached yet, the auditor absolutely needs to know about it. That discussion could signal a huge future liability, or a shift in strategy, or a fundamental risk. The auditor needs that context to assess the bigger picture. The completeness of information provided is paramount. Even if every tiny detail isn't financially material itself, the auditor needs the full story.
Okay, this is really starting to come together. So it's the top brass signing a letter, confirming material disclosures, confirming the integrity of their information, acknowledging they gave the auditors everything. Now that we get the purpose, who signs it, and this key idea of materiality, what specific things does management actually promise or confirm in this letter? What are the key sections you'd typically see let out?
Right, this is where we get into the real substance, the detailed commitments management makes. The letter is pretty structured to make sure all the critical areas are hit.
Okay.
First, you'll always see a section on core financial statement responsibilities. Here, management explicitly confirms their responsibility for the fair presentation of the financials according to the rules, like GAAP.
So they're saying these numbers are right, and it's our job.
Basically, yes. They assert the financials accurately reflect the company's position, results, cash flows, but it goes further. They also acknowledge their responsibility for the design, implementation, and maintenance of internal controls. Controls relevant to preparing financials free from material misstatement, whether it's from fraud or just error.
Ah, the controls again. That's a big one.
It's huge. It clearly states it's management's job to have systems that prevent and detect problems from the start. Strong controls aren't just something the auditor checks. They're management's responsibility.
So it's not just about the final numbers being right, but also the underlying systems and processes producing those numbers. That feels like a critical distinction.
It absolutely is. It's about building that solid foundation. Next up, the letter addresses the completeness of information and access. Management formally confirms they've given the auditor all relevant information and access that was agreed on when the audit started.
Everything they asked for.
Everything. Records, documents, unrestricted access to people the auditor needed to talk to. They also assert that all transactions have been recorded and are fully reflected in the financials. This is vital. It tackles the risk of unrecorded stuff, which could seriously distort the real picture.
Like hiding debts off the books.
Exactly that kind of thing. This section puts management on record saying everything's been recorded. Then we get to the really critical area of fraud. This section is incredibly sensitive, carries immense weight. Management explicitly acknowledges their responsibility for designing, implementing, and maintaining controls, specifically to prevent and detect fraud. They have to disclose the results of management's own assessment of fraud risk, where they think fraud could materially mess up the financials.
So they have to assess their own fraud risks.
Yes, and they must disclose their knowledge of any actual fraud or suspected fraud that affects the company. And it gets specific, involving management itself, employees in key control roles, or others if it could have a material effect.
Wow, even if it involves management.
Especially if it involves management. And it goes one step further. They have to disclose knowledge of any allegations of fraud or suspected fraud, things communicated by employees, former employees, analysts, regulators, anyone.
Even just allegations, they have to tell the auditor.
Yes. These fraud representations are incredibly weighty. They put management directly on record about their awareness, their actions, their assessments regarding what are the biggest risks out there: deliberate deception.
That emphasis on fraud disclosure and even allegations seems particularly potent. It sounds like they're directly confirming they're not trying to sweep anything under the rug.
Precisely. It's about direct accountability for a really sensitive area. The letter also requires assertions regarding compliance with laws and regulations. Management confirms that any instances they know about or suspect of non-compliance with laws and regulations, things whose effects need to be considered for the financials, have been fully disclosed to the auditor.
Like environmental rules or labor laws.
Exactly. Things that, if violated, could lead to fines, lawsuits, major operational disruptions, all impacting the financials. Then there's a section on uncorrected misstatements.
Things they found but didn't fix.
Right. Even after a thorough audit, there might be small errors, maybe misstatements, that management decides not to correct because they believe the effects are immaterial. Individually and altogether, not big enough to matter for the financials as a whole. In the letter, Management formally asserts this belief. And importantly, a summary of these uncorrected items should be included in or attached to the letter.
Even the small stuff gets listed.
Even the stuff deemed immaterial, say a $5,000 misclassification between two expense accounts in a multi-billion-dollar company, might be immaterial. But listing it ensures transparency. It's a formal record of management's judgment call, preventing any later claims they hid something, even minor stuff.
Got it. What else?
Moving on, litigation and claims are covered thoroughly. Management discloses all known actual or possible litigation and claims whose effects should be considered, like lawsuits, patent claims, etc. They also confirm these have been properly accounted for and disclosed according to the rules.
Because those could cost a lot later.
Potentially, yes. Then there's accounting estimates. These involve judgment, right? Like guessing the useful life of an asset, or how much to set aside for bad debts or valuing complex investments. Management asserts their belief that the methods, assumptions, and data used for these estimates are appropriate and follow the accounting rules. Since judgment is key here, their formal assertion is vital for the auditor. Okay, estimates are covered. Related party transactions are another crucial area. Management has to disclose the identity of all the company's related parties, subsidiaries, affiliates, key execs, their families sometimes, and all related party relationships and transactions they know about.
Why the special focus there?
Because transactions with related parties might not be at arm's length. They might not reflect true market prices or conditions. So disclosure is critical for understanding the fairness of the financials. Management confirms they've been appropriately accounted for and disclosed.
Okay, nearly there.
Almost. Finally, subsequent events. These are things that happen after the financial statement date, say after December 31st, but before the audit report gets issued, which could be weeks or months later.
Things that happen after year-end, but before the report is public.
Exactly. Management asserts that all such events that require adjustment or disclosure under the accounting rules have been properly adjusted or disclosed. For example, if a major lawsuit settled, or a factory burned down, or they took on huge new debt after year-end but before the report, that needs to be disclosed so users have the most current relevant information.
That's an exhaustive list. It really covers the waterfront, from day-to-day stuff to potentially huge events. But you also mentioned additional representations, implying this standard list isn't always the end of it. Auditors can actually customize this letter.
Absolutely. And it's crucial that they often do. Beyond these standard items, auditors can, and very often do, obtain additional representations. These are tailored. They're specific to the company's unique financials, its industry, or particular circumstances they encountered during the audit.
Like what? What kind of things?
Oh, examples could include management's formal assessment of how a brand new accounting rule impacts their numbers, or their judgment on whether certain assets are impaired, worth less than stated. Maybe their specific intent to hold certain investments until they mature, confirmations about obsolete inventory, or restrictions on cash balances, or even detailed plans if they're going to shut down a line of business.
So it adapts to the situation.
Exactly. This shows the letter isn't just some generic boilerplate document you just sign off on. It's dynamic, it's customizable, it's tailored to the specific risks, complexities, and judgments involved in that particular company's financial reporting. It makes sure any unique areas the auditor really focused on are also explicitly covered by management's formal sign-off.
Okay, here's where it gets really interesting, I think. Maybe a bit more nuanced. Because sometimes even this comprehensive standard letter, it isn't quite enough. Audits can get incredibly specialized, right? Focusing on particular types of companies or very specific aspects of a business. And with that specialization, you often need extra tailored promises from management. Can you walk us through a couple of these specific scenarios where extra assurances are needed and why they're so vital?
Absolutely. The general MRL gives that broad foundation for the overall financials. But you're right, certain types of audits demand very specific, detailed extra assurances. This is usually because of unique regulatory environments or just the nature of what's being audited.
Okay, like what?
Well, one really significant and impactful example is the ERISA plan financial statements audit. ERISA, that's the Employee Retirement Income Security Act, is this complex federal law. It governs most private sector employee benefit plans, things we rely on like 401ks, pension funds.
Right, retirement plans. Big deal for lots of people.
Huge deal. Auditing these plans requires extra layers of diligence. There are unique rules, huge fiduciary responsibilities involved. These plans hold the retirement savings for potentially thousands of individuals. So on top of the general representations we just talked about, the auditor must ask for specific, often legally mandated, extra representations from management.
What kind of extra promises?
Things like formal confirmation that management gave the auditor the most current plan instrument, including all the amendments, for the period being audited. This is crucial because the plan document itself dictates how everything works, how assets are managed, how benefits are calculated, how things should be reported.
The rule book for the plan.
Exactly. Management also has to explicitly acknowledge their responsibility for administering the plan correctly, making sure all transactions follow those plan rules. And a really specific, profoundly important part, confirming they maintain sufficient records for each participant. Enough detail to determine the benefits due, or that might become due, to every single person in the plan.
That sounds incredibly detailed, personal almost.
It is. It's directly tied to people's life savings. Any mistake there can have devastating personal financial consequences for employees, not just corporate ones. Absolute accuracy is paramount.
Wow. Is there anything else specific to ERISA plans?
Yes, something quite interesting happens if management chooses to have what's called an ERISA Section 103A3C audit. This is a limited scope audit. It often involves using certified investment information that comes directly from a qualified financial institution, like a bank or insurance company holding the plan assets.
So they rely on the bank certification for part of it.
In essence, yes. But if they elect this limited scope, management must specifically acknowledge in the representation letter that making this choice doesn't reduce their overall responsibility for the plan's financial statements. They also have to confirm that all the criteria for doing this limited scope audit are actually met. For instance, ensuring the investment info is prepared and certified by a qualified institution, that the certification meets strict Department of Labor rules, and that this certified info is properly measured, presented, and disclosed in the financials.
So even when the scope is limited, management still has to formally take responsibility for their part and ensure the rules were followed.
Precisely. It highlights just how complex and specialized these audits can be, and how management's representations provide critical assurance, even in that limited scope situation. They formally accept responsibility for the parts the plan auditor isn't directly examining.
That's a very specific and impactful example, especially thinking about how many people rely on those retirement plans. What about another common specialized audit scenario? I know for many public companies, auditors don't just look at the financials, they also have to check the company's internal controls. Does that require extra representations from management too?
Yes, absolutely. And it's a huge area of focus, especially for public companies. That brings us neatly to internal control over financial reporting, often done as part of an integrated audit.
Integrated audit.
Right. For many public companies, particularly in the U.S. under the Sarbanes-Oxley Act, or SOX, the auditor doesn't just give an opinion on the financial statements. They also issue a separate, distinct opinion on the effectiveness of the company's internal controls over financial reporting. It's integrated because the audit of the financials and the audit of controls are done together.
Two opinions in one audit, basically.
Exactly. And because of this dual opinion, the auditor absolutely must get extensive additional written representations from management. These are specifically about their responsibility for and their evaluation of internal control over financial reporting.
So another layer of promises specifically about controls.
A significant extra layer. In this scenario, management explicitly acknowledges their responsibility for designing, implementing, and maintaining effective internal control over financial reporting. That's step one. Crucially, they also have to state that management has performed its own evaluation of how effective the entity's internal controls were as of the end of the fiscal year.
So they have to assess their own controls first.
Yes, that's key. It's management's assertion about their controls, not the auditor's assessment initially. And management also has to formally affirm that they did not rely on the auditor's procedures as the basis for their assertion about control effectiveness.
Why is that distinction so important?
It clearly separates their roles and responsibilities. The auditor is there to evaluate management's work and assessment, not to do that work for them. It prevents management from later saying, well, the auditor tested our controls and didn't find anything, so it must have been okay. No, management asserts first.
Okay, clear separation of duties. What else do they promise about controls?
Furthermore, management must confirm that all significant deficiencies and material weaknesses in internal control have been disclosed to the auditor.
Significant deficiencies. Material weaknesses. What are those?
Good question. A significant deficiency is a control lapse, less severe than a material weakness, but still important enough to need attention from those in charge of governance. A material weakness, though, is more serious. It's a deficiency, or a combination of deficiencies, such that there's a reasonable possibility that a material misstatement of the company's financial statements will not be prevented or detected on a timely basis.
So a material weakness means the controls might fail to catch a big error.
That's the essence of it, yes. Management has to disclose all of these known issues to the auditor. They also have to indicate if any weaknesses identified in previous audits are still unresolved.
Full transparency on control problems.
Absolutely. They also need to describe any fraud that resulted in a material misstatement or any fraud involving senior management or other key employees, reinforcing the general fraud disclosures, but tying it specifically to internal control effectiveness or lack thereof. And lastly, management states whether there were any significant changes to internal control after the as-of date of the report, making sure the auditor knows the current state of the control environment right up until the report date.
So management isn't just saying they have controls, but that they've assessed them themselves and they've been totally upfront about any weaknesses they found. That seems like a huge burden, a huge responsibility on them.
It absolutely is.
Okay.
And the consequences of failing to get these specific representations for an integrated audit are just as severe as failing to get the general letter. It's considered a scope limitation.
Meaning the auditor couldn't do their full job.
Exactly. The auditor couldn't complete their work as required by auditing standards because they didn't get necessary evidence from management. This generally results in the auditor either withdrawing from the engagement entirely or, at a minimum, issuing a disclaimer of opinion specifically on the effectiveness of internal controls.
So again, either walking away or putting out a huge red flag about the controls.
Right. It just underscores how vital these management representations are. The auditor needs them to fulfill their obligations and provide that complete, reliable report to the public, giving that holistic view of both the financial health and the underlying control environment.
Okay. So what does all this mean if, after all these critical promises, all this formal documentation, there's suddenly doubt? Doubt about the reliability of these representations. What if the auditor, who's put so much weight on this letter, starts to question the very truthfulness of what management is saying? Maybe because something else they found just doesn't add up.
Yeah, that raises the most fundamental question, doesn't it? It's perhaps the ultimate test of the auditor-client relationship and really the audit's integrity. If the auditor concludes that the written representations they've received are not reliable, it triggers immediate serious alarms.
Why might that happen?
Well, it could happen for several critical reasons. Maybe there are deep concerns about management's basic competence, or worse, their integrity, their ethical values, or just their general diligence in providing information throughout the whole audit process.
Like if they seemed shady or evasive all along.
Exactly. If an auditor discovered management consistently withheld information or gave deliberately misleading verbal explanations, that would immediately cast serious doubt on their signed representations later. Alternatively, the doubt could stem from unresolved inconsistencies.
Conflicts between the letter and other evidence.
Precisely. Inconsistencies between what's written in the representation letter and other audit evidence the auditor gathered independently. Imagine this. The MRL explicitly states there are no unrecorded liabilities. Crystal clear. But then the auditor, doing their own testing, finds a huge vendor invoice. It's dated before the year end, clearly relates to that period, but was never recorded in the books.
Ah, a direct contradiction.
A direct contradiction. That's an immediate major red flag. It compromises the reliability of that specific representation and potentially the entire letter. In a situation like that, the auditor must immediately and profoundly consider the possible effect on their audit opinion, because the very foundation of their audit work is built in part on believing these representations.
So it's not just about what the letter says, but about whether the auditor truly believes what management is signing off on, based on everything else they've seen and found. And if that belief falters, if they really doubt management's honesty, then what's the ultimate consequence? What's the auditor's final move?
Exactly. It boils down to trust, but trust backed by evidence. If we connect this to the bigger picture, the ultimate consequence of that kind of deep doubt is incredibly severe. It represents the auditor's absolute final line in the sand. If the auditor, after careful consideration, after trying to resolve the inconsistencies, concludes there is sufficient doubt about the integrity of management itself.
If they think management just can't be trusted.
Yes. If they reach that conclusion, then the professional standards are clear. The auditor should disclaim an opinion or withdraw from the engagement. This is the nuclear option for an auditor.
Disclaim or walk away entirely.
Yes, because trust in management's integrity is absolutely paramount. It's foundational to the entire audit process. Without that fundamental trust, without the belief that management is being truthful and transparent in their formal assertions, the auditors simply cannot rely on their representations as valid audit evidence.
And if they can't rely on the representations?
Then the whole audit is compromised. Because, as we've discussed, these representations general, specialized, they form the bedrock for so much of the audit evidence. Confirming completeness of records, disclosure of fraud, existence of controls. If you can't trust those confirmations, the audit becomes almost meaningless. It renders the auditor unable to provide credible assurance. It's a testament, really, to how profoundly crucial this document is, not just as paperwork, but as a direct reflection of management's trustworthiness. It's a cornerstone of the auditor's ability to give a credible, meaningful opinion to the public. Without that trust, the entire system of financial reporting starts to break down.
Wow. So what we started with, the seemingly simple piece of paper, the management representation letter, it turns out to be this incredibly powerful, mandatory, legally significant document. It's the pivotal moment where management formally puts their reputation, their careers, often their direct legal standing, right on the line, unequivocally affirming the accuracy, the completeness of their financial information, the effectiveness of their controls. It's just a moment of immense, undeniable accountability.
Precisely. It serves as the ultimate formalization of trust, yes, but also critical documentation of accountability. And it's that crucial piece of the puzzle that allows auditors to render their opinions with confidence, with credibility, to the market. It's really a testament to all the layers of assurance and diligence that go into financial reporting, things that might otherwise go completely unseen by, the casual observer. It solidifies those verbal agreements, puts critical judgments into writing, ensures there's a definitive, undisputed record for the future for any stakeholders who rely on that audit report. It truly is the signature that ties everything together.
This deep dive really highlights how even the most, maybe, mundane-sounding documents can hold just immense power and significance in the financial world. It's fundamentally about transparency, isn't it? Accountability. And the very foundation of trust that keeps our complex financial systems functioning. So, thinking about your own professional life, what responsibility do you have to formally document critical information, even if it feels repetitive sometimes, or maybe obvious? How might a simple written confirmation, something like this letter, prevent massive misunderstandings or maybe even devastating disputes down the line in your own projects or your professional relationships? Perhaps there's a representation letter equivalent in your world that you haven't formalized yet, but maybe you truly should. Thank you for joining us on this deep dive into the management representation letter. We hope you feel a little more in the know now and perhaps even a little inspired to look for those hidden but crucial documents in your own fields. Until next time, keep digging for knowledge.